Daniel, great to have you here. The first part of the conversation, I would like to focus more on something that we see pretty often in Silicon Valley that is much less seen outside of here. That is the ability of professionals here to be able to hop in between very many different verticals and yet being super relevant. And so I think you're a great example of that. So you studied philosophy, I think if I'm correct, at Harvard, and then you went into tech, and then from tech, then you went to be an entrepreneur. From entrepreneur, you went to be a VC. From a VC, you went to be a specialized VC as well. So the whole 9 yards. So tell us, let's share a little bit of
I have no sense of focus.
Or let us know how can you be focused and being able really to in a relatively short period of time. To find really content and passions in area that seem to be so different. So let's talk about a little bit of your upbringing. What took you to Harvard, and then from there, the first few steps from there to tech.
Sure. So I grew up in Boston, and I started playing with technology early on in high school. In the early 1990s, I started an electronic bulletin board system before the World Wide Web existed. And the internet is many decades old. And so my bulletin board system had a connection to the internet. And so I was talking with other people and had an online community through that. But it was still before the web existed. And so
what years are we talking about here?
The early 1990s. Okay. Yeah. And so I discovered that I like to play around with new technologies and find ways to connect with people and build community, and so that has been a theme for me. But more broadly, there was, I believe it was a 13th or 14th century Japanese swordsman called Miyamoto Musashi, who wrote a book called the Book of Five Rings. And he talked about how there are certain. Do you know the book?
Yeah.
Someone knows the book. You know the book. Yeah. And he talks about how there are certain commonalities and fundamental principles in sword fighting, but also in life in general. And so, as a philosophy major, I've always found that everything is a manifestation of first principles and an application of first principles. And so, while on the surface, my career has had a number of different approaches, the underlying theme for me has been a consistent sense of curiosity, and that has brought me to explore different applications of certain core ideas.
And so you graduated from Harvard. How do you end up in tech? Well, first job was NEC maybe, or am I correct? Or Siebel was right after.
Yeah. You've been looking at my profile. So I wanted to study at after Harvard. I wanted to study at a Zen Monastery, but why not, right? But instead, I found a professor who was sort of he was a Harvard Business School professor, and he was a little bit of a Zen monk kind of person. And so I was an intern for him at his software company. And so I started learning the basics of software product development while also learning how to think and how to be. And so that was kind of my first job after school. And then I came to San Francisco in the middle of the dot-com bust in 2001, and nobody was hiring, but finally, I sort of scraped by for a couple of years and managed to get a job in management consulting, which many Harvard graduates go into, and so I worked in management consulting focused on the tech industry, and that was the platform for my career. And I worked at NEC Corporation because it was Japanese, and I wanted to get closer to Japanese swordsmanship philosophy.
But, so what brought you to Silicon Valley as actually in a dot bust?
Yeah. So when I was in undergrad, I started a soccer website. You're all Italian, you should appreciate this. Americans don't appreciate soccer, but I know you do. And so I started a soccer website in 1999 and raised a couple $1 million in venture funding. And I took time off from Harvard to start it, and started it out here in Sunnyvale because Silicon Valley seemed like a very exciting place. So I started out here and fell in love with the Bay Area. I also did a summer internship in San Francisco in branding in 1997 and naming, very kind of niche industry, comparatively speaking. And I just fell in love with the Bay Area.
Sorry to interrupt. What was about this soccer?
So the context, I was 21 years old. It was 1999. I had no idea what I was doing. So it was all things soccer. There was very little focus. It was soccer news. It was a soccer news portal. It was a soccer community site where fans could talk with each other and also experience a virtual reality interface and like play soccer in this virtual stadium. And it was soccer e-commerce. And it was way too much to do with a $2 million raise back then. But
now you know it.
I would never fund myself. Back then.
So,
but those were different times back then. And these things were popular. You know, the portal idea was very popular in 1999.
Right, the Yahoo world
Exactly.
of portals. And then you went to business school. That was right after, or you did your
after.
So did your CouchSurfing appear after business school?
Actually, before.
Before.
Yeah. So I started a travel website with a friend in 2004 called CouchSurfing, and it was a platform and a community to bring people together and to facilitate intercultural understanding. And it had a powerful social mission to make the world a better place. And so we started as a nonprofit back in 2004, and here in 2020, the company is still around.
Was it planned? I mean, the whole business of CouchSurfing, of course, was not. But I'm just trying to prepare the question. So, I mean, it started as a not-for-profit, as an opportunity for you guys. There were 3 or 4 co-founders. 3 co-founders.
There were originally 4 co-founders.
4.
And two of us have stayed active over the years, and 2 less active.
So tell us a little bit more about the process, how that got started.
Yeah, so I've always enjoyed traveling, and one summer during college, I went bicycling from New Orleans to Atlanta in the U.S., which is about 800 miles. And along the way, I stayed in campgrounds and in some hotels, and also met random people along the way and went back to their homes and stayed with them in their homes. And then after college, I traveled through Southeast Asia a little bit, and I met some people in Bali and went to their homes and got to know them, and played chess at midnight and drank beer and things like that. So
how would you find a home there? I was
just talking to people. Yeah, just randomly. Yeah.
So do you have a bed or do you have a couch? So that's,
No, I mean, back then in Bali, the hotels cost $4 a night. So, I could always stay in a hotel.
It was even less fun.
Yeah, it was less fun. Yeah. It was more interesting to get to stay in someone's home and meet their chicken and, play chess and stuff. And so, I had those travel adventures, and then my co-founder as well had, his aha moment was he was taking a trip to Iceland. He needed a place to stay, and he sent an email to 1,000 university students asking if he could stay with some of them, and he did, and so he came to me afterwards and he said, "Hey, I think we could build a company around this, but let's not call it a company. Let's call it a project." And so we called it a project and made it a nonprofit.
But was the idea to turn into a potential business after that, or the call was that let's do things that we think is helpful for us and the extension of that.
Yeah, well, so as you pointed out, and you have clearly done your homework, there were originally 4 founders. 3 of the 4 wanted it to be a nonprofit. I was the sole capitalist, and so I wanted it to be a for-profit, but I was outvoted for many years. And so we were a nonprofit for many years, and then finally in 2010, we started the process to convert from a nonprofit to a for-profit, which, by the way, is very difficult. I don't recommend it.
Yeah, I've done it before. But so you couldn't raise money before, other than grants, right? So.
And not even grants, because in the U.S. to be a nonprofit, you need a federal certification, and we had a state level status as a nonprofit, but not a federal level status. We were not a 501c3, and as a result, we could not take in grant money. But since we were a sort of nonprofit, we wanted to be a 501c3. We tried to raise. We tried very hard, sending applications to the IRS to get 501c3 certification, but they kept rejecting us. And so ultimately, we were neither a full nonprofit nor a full for-profit. It was kind of the worst of both worlds. And finally, since the IRS kept rejecting us, we decided to become a for-profit.
Might as well. You won your bottle. How many years after the foundation?
It was basically 7 years.
Oh wow!
When it finally converted. Yeah.
And then you started raising money, so you went, the whole. But then was Airbnb already started? Had it already started?
Yes. So Airbnb started in 2008.
Yeah.
And we started the conversion process in 2010.
Okay, so.
So we were aware of them, and that was one factor that influenced our ultimate goal to become a for-profit. But ultimately. The IRS was probably the bigger factor.
So when not too long ago, Nico Bonazzos here from General Catalyst, this is one of your CouchSurfing investors. I think that was probably Series B, right? So, so even today, so the business still exists. The community is, if I'm correct, 40 million people, so significant. 200,000 cities. So I mean, it's still significant numbers. Do you think there's a future development, or?
I have, I left CouchSurfing in 2012. I was on the board until 2015. Since then, I haven't really been involved with it, so I don't know what's going on with the company at this point.
Do you have any regrets from those days?
Which days?
The days at CouchSurfing.
All 16 years, or?
Yeah, as a CEO, things that might have happened differently. I mean, you really hinted to the fact that you wanted to have a for-profit, from the beginning. Probably it would have bought you some time.
Yeah, I think you learn lessons along the way in various forms.
Which one in particular? Let's share with current and future entrepreneurs.
We all learn as we get older and see more of life. And so when I was first involved with CouchSurfing, it had various marketplace dynamics, and marketplaces are now my focus as an investor, one of them. And so I know a lot more about marketplaces now than I did when I was running CouchSurfing. And I even created a conference called the Marketplace Conference, which is happening in 2 months, and you guys are welcome to come if you want.
Where is that?
Here in San Francisco.
Which month?
26th of March.
There you go, March 26th. Marco can tell you the URL, and we'll give you a discount code to get cheaper tickets. But anyway, there are best practices in running marketplaces that we weren't really thinking about, and part of the reason was because we were a nonprofit, and so we were not optimizing for revenue generation or valuation or anything like that. It was a social mission-driven company. It's a nonprofit, and so we were optimizing for social impact. Do I regret that? The rest of the board had agreed to make it
No profit.
Had not made it for profit earlier. Yeah, I mean that was a regret I had even at the time.
How about finding the right partners and the right co-founders? That's because the number already. It's an issue, right? It's already sometimes difficult to be in two. Yeah. 4, you double the possibilities of conflicts or misalignments, right?
I feel very lucky with the co-founders because we were all very different people, but we all got along. There was always trust, and especially my primary co-founder, Casey. A co-founder relationship is like a marriage, and so there's, sometimes they work out and sometimes they don't. But typically, when it's a marriage, you know that it's going to be the rest of your life, and so you do a lot of due diligence into your partner first. Oftentimes, with a co-founder relationship, people don't put as much effort into making sure that they have the right spouse. So I think we got lucky. Casey and I are still great friends, and there's a lot of trust within the co-founders. Even the ones who are not involved anymore, there is still, there were never any problems in the relationship.
And now we're going to talk about your next phase or your current phase, next after entrepreneur as an investor. So on the other side of the table, what signals do you get now when you need to do your due diligence of whether or not the dynamics between co-founders is the right one? I mean, is it a positive one, or maybe you see some red flags?
Yeah. So you can get a little bit of a sense of it in the pitch meetings. How the co-founders relate to each other, and if one person is dominating the conversation, or if one person is trying to look smarter than the other person, or impress the investors more, or things like that. So that's always that's a concerning dynamic when we see that. We like to see healthy teamwork relationships and mutual support and respect and sharing the stage and have them both be smart and knowledgeable about what they're focused on within the business, but also differences in their area of specialization, because you don't need two people doing the exact same kind of work. Sometimes we see husband and wife teams.
Is that good or bad?
It's a slight bad. It can be overcome. Sometimes it works out, but there's a little bit more risk, because then you've got all of the marriage risk in addition to.
It's a double marriage.
Yeah, it's two marriages. So it just increases the chance that one of them goes wrong, and that's bad for the company. Yeah.
One founder versus four founders. Which one is the red flag?
So the best number is probably 2 or 3 founders, and I would prefer 1 to 4. Usually if there's 4, that means that, with any company, there's typically one person who's the real heart of the company. And that person, it's usually the person who came up with the idea. And usually that person is the most committed. And when things get tough, they will be the one that sticks around, and the other people may or may not stick around. It depends how tough it gets. So it's an interesting question to say, okay, in this group, who is the real heart of the company? And it's not always the CEO. Sometimes it's the chief technology officer or chief product officer or something.
Great. So back to your path. Let's go into your, following incarnation. The investor one. So when you start doing some angel investing and then turn into actually a profession?
Yeah. So I started out as an advisor to startups, and that was around the time that I was at CouchSurfing, and it was because I was learning things in that role, and I thought, well, it'd be nice to give back, but also I just thought it'd be fun to work with other founders and to help them and interesting. And so I started taking on these advisor roles, and so I started learning by advising these other CEOs. They learned from me, but I also learned from them. And so I took on a number of advisor roles before I wrote my first angel check.
Can we define what is an advisor role? Because there are different shapes and forms. I guess that if it's in local funded startups here, typically you get some sort of rewards, typically some stock options, right? Was that the case?
Mm-hmm. Yeah.
So you do get let's share a little bit of what is your ideal today, kind of a relationship between the right advisors and early stage startups.
Mm-hmm. Yeah. So advisors are good when you need someone on the team with deep specialized expertise, but you don't need them full time. And so that could be someone with a specific kind of technical expertise, or it could be organizational expertise, like how to structure a sales force, or how to hire good engineers, or how to do marketing, anything like that. Could also be someone like how to deal with VCs and how to manage the fundraising process. So an advisor is someone that you call on typically when you need something. Sometimes you schedule weekly meetings, but those rarely last. And so usually you just have a question and you shoot them an email or meet up for coffee, and you give them a small chunk of equity, maybe 0.25% of the company, depending on the stage.
And sometimes based on deliverables.
Sometimes based on deliverables. In my experience, mostly not, but yeah, sometimes.
You mentioned the last one, the advisors to help with the fundraise. This is something that, especially in Silicon Valley, I think it's not always seen as something positive. When you get somebody to pitch you that is an advisor and not the founders, how do you feel as an investor?
Well, so what I meant by an advisor to help with fundraising, I did not necessarily mean introductions to investors, because actually someone who makes introductions to investors needs a license to do that, a broker-dealer license, if they are going to be directly compensated as a result of the money that they bring in. And as opposed to someone who just has equity in the company in general, and then everyone can make introductions to investors, and that's fine.
Most people don't know that, by the way, so that's interesting to point to.
Yeah. So what I was referring to was someone who's just familiar with the fundraising process, who can talk about how to write a good pitch deck, how to position yourself, the types of questions that investors will ask, because we're not that creative. Like, most investors will ask most of the same questions. And so if you get someone who's familiar with the types of questions, then they can, for example, practice with you and help you figure out how to best answer them.
Good. Sorry, I interrupted you. So we were talking about your first exposure to other entrepreneurs as first as an advisor and then as an angel investor. Yeah.
And so I started getting to know what it's like to be advising founders, and I started to develop my pattern recognition capabilities to try to figure out which companies have the best chances of getting big. And so my track record as I've gotten older has improved, because you see more companies and you start to get a better sense of what's important and what's not important, and how to think about it. So early on, I did not want to risk actual money, because I was still training my own pattern recognition engine. And as I got more confident, I started putting some money into startups as well.
In any area specifically, you were talking about before, some marketplaces.
Yeah, I mean, I think my early experience with CouchSurfing has shaped many of my investing interests. So I tend to invest in marketplaces, B2C, sharing economy, and so I'm pretty familiar with those domains. And so many of my investments have been in those areas.
And that takes me to the last chapter, so Autotech. And that domain is pretty specific. Like, there are some variable boundaries, but what took you to Autotech first? And also the subject matter.
Yeah. So I invested in a handful of transportation-related companies. And I did that both personally. I was a seed round investor in a company called Spot Hero, which is a parking marketplace. That was back in 2012. And then I also made other investments. I worked at another venture firm a little bit later, and I made a couple of transportation-related investments there. And then I kept bumping into Autotech Ventures, which was a new firm started in 2016. And working on some deals with Autotech, and I sent them a few deals, including some that they invested in and others that they looked very closely at. And I had a monthly breakfast meeting with Alexei, and we talked about our portfolios together.
Alexei is one of the managing partner that actually was here with us last year in a chat like this.
Yep. So I got to know the firm through Alexei, and we got to know each other, and then they were looking to bring on a third partner, because there were only the two founding partners at the firm, and they wanted the first outside partner to come in. And after a 20-month interview process, they brought me in as the first outside partner.
And typically, the outside partner come when there is a new fund, right? That's typical because you're entering into a new partnership. I guess a part of the rule is that you help with the fundraise, right, of the new fund, or partially. Let's talk about your value proposition today, and maybe if it has shifted from Fund 1 to Fund 2, right? Autotech was one of the first few funds fully focused on mobility, Autotech in general. Is the value proposition change over time?
So the value proposition is the same right now in Fund 2 as it was in Fund 1, and we are focused on a very narrow and very broad opportunity at the same time. It's very narrow because it's only things to do with ground transportation, but that is a $3 trillion industry and a global one. And we also define it very broadly. So anything from deep tech to things like semiconductors and AI to business model innovations in areas like marketplaces, fintech, and SaaS. And basically, we'll invest in anything that touches anything with wheels, with the exception of airplanes, which do have wheels, but we don't do airplanes. So.
I was about to ask you actually. I mean, this is another big trend now. With all the flying cars, right?
Yes.
There's so much money being poured into that. You don't do that.
We don't do that.
Good. Yeah. So at least that one off.
Yeah. So it's a global industry. Most of our investments are in the U.S., but we have a handful outside of the U.S. and in Europe, and one in Africa, and one in Canada.
What's the one in Africa?
The one in Africa is a bus-related company, and they're a marketplace that helps commuters get to work on time in shared buses, kind of like Careem, sort of like Uber for buses, to facilitate your daily commute to work.
So it's app-based, right? So
App-based, and it's a premium offering. They're in Egypt and Kenya and Pakistan. And in Egypt, for example, it's a premium offering because the buses have air conditioning.
Well, it opens up a total different kind of chapter of discussion. The market opportunities outside of the US and Africa is one that very few people are talking about still, which I think is a significant, opportunities. But back to some of the things that you've been seeing in the last few years, some new business models that you're feel pretty bullish about, driven by new technology.
Yeah, that's an interesting question. New business models.
Well, let's talk about technology first. Probably it's easy. Maybe we can discuss about business models related to that.
Yeah.
So there's a whole, focus and interest of self-driving at different levels. How do you guys see the real opportunity around self-driving? What kind of business model do you think will be the one that will get the best outcomes?
Yeah, self-driving technology is technology. There's always technology, and then there's business models built on top of and around it. So, and we're skeptical that the technology is going to work anytime soon. And so we have a thesis that it's not going to work anytime soon.
In no specific, because there are trucks, right? Self-driving, there's a B2B, they're all different shapes and forms.
Usually the reality is not as compelling as the way it's marketed once you dig into it. And so we do think that there is an area of opportunity around what we call off-highway autonomy. So the problem is, for on-highway autonomy, you can't control anything. You don't know when the kid's going to run across the street chasing the ball, or there's going to be a construction site, or there's going to be snow or rain or a broken stop sign or what. I mean, there's just a million things that can go wrong on the highway. If you can control the environment, if, for example, you have a fixed environment and the vehicles are only inside the space of something the size of a parking lot, and you can geofence that space and control what goes in and out, the problems get a lot simpler. And so examples of environments like that are agriculture, like farms, and construction sites, and mining sites. And so we have investments in a construction and mining autonomous startup called Safe AI, and in a agriculture technology startup called Verdant, because we believe that the challenges they face are much easier to solve and can be solved much more quickly compared to on-highway autonomy. In terms of business models, I mean, I think, it's kind of like saying, well, what are the potential business models for cars? There are a lot of different business or vehicles. Like there are a lot of different possible business models for vehicles, and so some of the ideas that people like to talk about with autonomous vehicles is the idea of commercially owned fleets, and those could be owned by a Lyft or an Uber, or some other company that doesn't exist yet, just waiting to be funded, or any other types of players. So there's this concept of fleets of autonomous cars driving around. It'll probably happen eventually, but not very soon. The things that are inhibiting adoption of autonomous technology are weather is actually a big one, and then access to mobile signals. People talk about the rise of 5G, but for example, 5G exists almost nowhere in the country. So, when someone builds a car, they expect the car to work in Las Vegas, and they also expect the car to work in the back roads of Alaska in the snow. And so some of these technologies can be rolled out much more quickly in Las Vegas than they can in rural Alaska. But the manufacturers need to build to the lowest common denominator.
What do you think about the whole, hype that has been around the last mile transportation, right? The electric scooter and all that. It's been, billions and billions of dollars being poured there, and I think the jury's still out. Mm-hmm. Have you guys invested in some of those? We
haven't. We have looked at about 20 of those companies, and we've stayed away from all.
Not to.
Yeah. Yeah.
What made you decide that that's not a good bet?
So when you invest, you're investing into a company, not a trend. And we believe that there's a trend, but not necessarily a company to invest in. And so the trend is that micromobility and scooters are clearly there's a lot of interest and a lot of adoption, but whether or not any of them are sufficiently defensible as a business to prevent long-term reduction of margins is unclear. And we're starting to see the contraction of the industry now as these companies exit unprofitable markets and reduce headcount and things like that as they're chasing profitability. So we've stayed out of it because we're not sure that they can build a long-term profitable moat around the industry.
How about the service providers for those? So charging stations, tools, they have more predictable business models.
We've looked at that, and we have not found enough defensibility within those companies to invest in those companies. So one school of thought is to say, we'll be the arms suppliers, right. Or we're going to provide the Levi jeans or the shovels to the miners. Right. But if there's no defensibility in the shovels, then other people can sell shovels too with lower margins. And so we've stayed away from that as well.
What do you think will be the roles of the large automotive industry today, or the OEMs 5, 6, 10 years from now? Because everything, one of the statistics that we keep tracking is who's leaving Silicon Valley in particular in the last few years. This has become, the world of the automotive industry. I don't think there is a single provider that doesn't have maybe 2 people here in a co-working space that try to figure out whether or not they will be alive 10 years from now, and if yes, if there are opportunities for them. So what do you think their role will be 10 years from now?
I think in many ways it'll be similar as it is today. When the car was first invented a little over a century, there were hundreds of car manufacturers, hundreds, and then today there are less than 10, right? And over the last 50 years, there have basically been less than 10, right? So massive consolidation in the industry. So then the question is, will that number be reduced further, or will there be more? I don't think there'll be more. Maybe it'll get reduced a little bit. But at the end of the day, people still need to get around, and so some of these companies are taking a broader perspective in terms of their self-identity and moving, expanding beyond cars and also into scooters and buses and things like that. And they're taking a holistic view, and I commend them for recognizing that opportunity. And then there's also the possibility that if there is a future around autonomous fleets, that the cars will start selling into fleets instead of into consumers, and so then the customer of Ford becomes companies, not people anymore, and so that has the opportunity to change a lot of dynamics and how the industry is set up with dealerships and the sales process and marketing and all sorts of things. But aside from the obvious technologies that we're all sensitive to, like autonomous technology and so on, at the end of the day, I think the car will still, 10 years from now, will still look more or less like a car.
Mm. One of the areas where we're asked to advise is whether or not it makes sense at a certain moment to set up one or many corporate venture funds. Mm. What's your take? What's your vision when it comes to the automotive industries? The large brands, take it or leave it, they all have a VC fund. What is your some? What's been your experience, and you think is that a good use of their resources?
So many of our investors are large corporations, and
you want to share some names? Is that
many of them are actually not public.
Okay,
but many of our LPs are publicly traded multinational companies that you've heard of. Some OEMs, some tier 1 suppliers, some car dealerships, companies like that. And they give us money to because they want financial returns, and also because they want access and visibility into trends in companies that could impact them. And I think it's a very smart thing to do, because they're very good at what they do, but they don't spend all of their time around Silicon Valley meeting with startups, and it's just a different skill set, and it's a different perspective, and so I think investing in venture funds is a good way to get access to these things.
I turn the question. Do you have some experience of corporate venture capital in the automotive industry that you think have been very successful?
Yeah. I mean, I think corporations sometimes set up their own venture arms for. They set them up for multiple reasons, and so sometimes the goal is to make money. Sometimes the goal is to provide strategic benefit, and sometimes both. And sometimes those two things are at odds with each other. And so in some cases, corporate venture arms will invest in money-losing propositions because they're not going to make money on the company, but they gain something else from the relationship. And that's fine. But they're just different things. So we are an independent venture firm, and we're financially oriented, and so we try to be helpful to our corporate LPs, but we have a different charter, and we can also move much more quickly than a corporate venture arm.
Got it. So I mean, your KPI is pretty clear. When it's kind of for others, when the returns can be divided in different areas, it's more complicated also to read what is the successful.
Yeah.
Last question that I have for you. What do you think about the Hyperloop movement overall? Do you guys invest in? There's no wheel there, so I'm not sure if that applies with your definition of transportation.
We've considered it, and I think it would qualify if we wanted it to. It's probably wheels somewhere, but we don't typically invest in capital-intensive companies, and it's very capital-intensive, and so there are a number of risks with that. So, there's a lot of regulatory and kind of legal risk, and then there's also a lot of capital required, which dilutes us with every subsequent round. And then there's the question of, what does the exit look like? Will they get acquired by somebody? Probably not. Will they IPO? Maybe. And so anyway, it's not a perfect fit for a venture firm such as ours.
Got it. And
But I hope it happens.
yeah, so that's probably the main question. If it happens, when it's going to be a Concord-like kind of all or nothing. I'm actually just back from the Middle East, where this is a clear, especially in Dubai and in the Emirates, is the test bed of lots of those technologies, because you need capital, you need space, you need rules that will allow you to do the testing without disrupting too much of that. All right, I think that's a great discussion. So thanks for coming.
Yeah.